All eyes are on the mortgage markets. Rates are spiking as fast as we've ever seen it. Markets are reacting to war and inflation and fears of a coming recession, maybe. Lenders reporting 4.5%, some getting closer to 5% on the 30-year mortgage. This is at the same time that home prices this week hit a new record high. So how quickly and how abruptly will consumers react? That's what we're watching for each week. Every week, Altos Research tracks every home for sale in the country, all the pricing, all the supply and demand. We analyze all that data and the changes in that data, and we make it available to you before you see it in the traditional channels. I'm Mike Simonsen. I'm the CEO of Altos Research. And let's look at the data, see the details for the week of March 28th. 2022, end of first quarter. Let's start with home prices today. We have a four handle. The median home price in the U.S. is $400,000 for the first time ever. That's up a tick from last week, just as you'd expect for this time of year, just as mortgage rates also spike to their highest level in years. The home buying season is kicking in, and so prices climb each week. When I say record home prices, which we're at a record, this is what I mean. This data here is not an index, it's not a model. This is measuring every home for sale in the country right now. If you walk into the market today, this is what you'll see. And for the first time ever, you'll see a median price of $400,000. Prices cluster at these big thresholds, so it might take a few weeks for the median price to keep climbing higher. But every week it's been inching up. But we have a lot more buying season still to go. In normal years, prices peak at the end of June before retracting a little bit towards the end of summer and then dipping over the holidays. My suspicion is that this year, despite rising rates, will follow that same pattern. So maybe expect 430 or 440,000 by June. Keep watching each week, and we'll see if that holds. I've labeled the beginning of the pandemic here. On the dark red line, the median price was just $328,000 at that time. You can see 3 tiny weeks of dip in prices before the market started blazing up again. The median price of the newly listed cohort ticked down this week to $399. It's back below the full market for the first time in weeks. This is also normal behavior. So the new listings price has been basically unchanged for 5 weeks now. And this shows us that demand isn't doing some like crazy accelerating like it was last year at this time. So the new listings get their biggest push in the first couple of months of the year, then peak in April or so, and then they plateau for a while. You can see the light red line here. That's the price of the new listings each week. The light red line here plateaus. See it peak and then plateau a month or two before the dark red line. That's the full market. So in the pandemic market the last couple of years, the price of the new listings never backed off in the third and fourth quarter because demand stayed incredibly strong well into the fourth quarter each year. It's looking more normally seasonal this year. So we'll have a little bit, we have our continual price climb on the red line and then backing off in May and June on the light red line here. That's what we expect. Inventory has definitely turned a corner. Available inventory of single-family homes rose 2% this week to 253,000. The point I like to call your attention to on this chart is 2018. In 2018, the mortgage rates rose to 4.9%, and the market slowed noticeably. In inventory numbers, you can see that it was about a 4% rise, 3.5%, 4% rise, more than the year before. So each year, though, we've normally been losing inventory, and that 1 year with rising rates, we had rising inventory. If you were selling your house in 2018, you really noticed that slowdown about August of that year. Ultimately, it never got that slow, so It was scary for a few weeks, but as a seller, but then it was fine. As of right now, that's our best model for what to expect for the rest of this year, 2022. If rates spike substantially above that, like above 5%, the comparisons become a little more difficult. Rates haven't been above 5% for over a decade, and it's really hard to compare anything about today's housing market with 2011. So right now we can anticipate rising inventory, but no big flood. If you are in the group of people who are anticipating some big flood, sellers who suddenly rush to get out before the market turns, don't hold your breath for a big wave. Because prices have run up so far, so fast, you should anticipate some folks trying to capture those gains. So especially in second home and investment properties, we should finally start seeing some more inventory, people capturing some of the equity gains. I think we'll actually see it pretty quickly here in these numbers. But remember that if mortgage rates really squash demand, none of these sellers have to sell. They've got great equity, they've got locked in great rates, and they have high rents. So nobody has to sell those properties. And it's hard to imagine any downward spiral. Instead, to get back to any level of inventory that we consider normal, I'd expect that, we need a couple of years of higher rates. So maybe that's what we're in for. Maybe inventory gradually climbing each year, the reverse of the last decade. That's a little speculative, but let's look at what we can measure in demand right now. Price reductions. So the percent of homes on the market that have taken a price cut ticked up this week to 16.9%. Compare that to last year at this time, 16.1. Last year it was still accelerating. 2 years ago, at the onset of the pandemic, price reductions were at 25.5. And in 2019, this is when we were still recovering from the rate rise of the year before, the 28% of the market had, in March, had taken a price cut. So when you're used to only 1 in 5 taking a price cut, and then 1 in 4 feels like a real slowdown, even though it's not that big a deal, but it feels like it. So assuming rates continue their trend, that's what we're looking for later this year. You can see demand very clearly in price reductions. When the demand isn't there, those people that overpriced, tried to max out their price, have to take a cut. And so we'll see those ticking up. The normal rule of thumb is about 1/3 of the market nationally takes a price cut before they sell. And we're only at 17% right now. So we expect that to start adjusting up, but not get to anything scary where there's a big wave of new inventory. Immediate sales are still super hot, of course, too. So a third of the 94,000 new listings last week are already in contract. You can see the light red portion here of the line is growing. More buyers, even as the dark red is growing too, more listings as we roll into the second quarter. So I suspect we'll hear anecdotes of sellers not getting their bidding wars before we start seeing it in these measures. I haven't really heard any anecdotes of that yet, but maybe in the next few weeks we start to hear those if rates stay where they are or keep going higher. As of right now, buyers have not backed off one bit. We'll keep watching for any change right here. Here's another way to watch for a changing market. Relists. So sometimes homes get an offer, they go into contract, and then the contract fails. So this could be because of inspection issues or financing falls through, or maybe the buyer finds a better deal and they walk. So deals fail. It happens, always happens. I've shared previously relists as a percent of the active market. So what percent of the market has been listed previously. But here is the total volume. And it's really striking in this view. So these are the homes that are on the market that we can see went into contract and then came back out later, relisted for sale. As the market heated up a couple years ago, fewer and fewer contracts failed. That's because I fought so hard to get this house. I am not going to let this deal fall through. I'm going to make it stick. Also, I have my financing in place. I'm paying cash over the appraisal to make sure that the loan works. All of these pieces have forced us to created fewer and fewer relists each year. So you can see that dramatically fewer deals failing in the last couple of years. In fact, I was talking last week in the Altos Research Top of Mind podcast with Joe Curtis from the Pango Group in Southern California. Pango is a closing services firm, and they see a ton of transactions in California each year. Joe pointed out how Pango's closing efficiency climbed dramatically during the last 2 years. And you can see it here. These deals are getting done, fewer and fewer relists. So we're going to keep our eyes on relist rate this year. By the way, this measurement also corresponds to cancellation rates in new home sales that the new home builders report, cancellation rates. And I spoke with Ali Wolf from Zonda a few weeks ago on the Top of Mind podcast about this correlation. So if you haven't had a chance to listen to the podcast, check it out. Joe Curtis last week, and we talked about the closing efficiency improving and why that has happened. We also talked with Joe about crypto and Bitcoin and how those things are impacting real estate transactions right now. And then Ali Wolf was a few weeks ago where we talked about how this corresponds to the new home builder data, and you might get a view there. So if you haven't listened to the Top of Mind podcast, give it a listen. Okay, that's all the data we have time for this week. Stay tuned to the YouTube channel each week for these videos, our webinars, and we also put the Top of Mind podcast if you like to watch us talking to each other. As always, this market is nuts and it's scary. And so your clients need to know what's going on. If you need your clients to not be afraid, you need to get them the data. So go to altosresearch.com right now, book a local market consultation with our team, get the data for your clients right now. All right, everybody, more next week.